So learning objective 4 is an interesting way of using incremental analysis because some products you can sell um, at one point, or you can process it further and sell it at another point. So for example, wooden furniture, you can actually build say the bookshelf. You could say a wooden bookshelf and leave it unstained and unfinished, but it's a wooden bookshelf, and you can sell it that way. Or you can process it further, which means you can paint it, put stain on it, all this other stuff, and sell it that way. So that's basically what this sell or process further issue is about for products that can be sold at a certain point, and the manufacturer has the option of processing further uh, to actually do something different with it. So in essence, we have this decision rule. We look at the additional revenue. Any incremental revenue needs to exceed the incremental costs of processing things. So there's two different products that we're going to be looking at here. One is a single product model, and another is a dual product. So let's start with Woodmasters. They make tables. Woohoo! The cost to the manufacturer to create that unfinished table is 35 bucks, and they can sell that unfinished table, at 50 bucks. So that's for the unfinished table. However, they have unused capacity in their factory, so they can actually continue to process the table, finish it, which means they could sell it for $60 instead of 50. However, for a finished table, they're going to incur some additional costs, right? It'll increase direct materials by $2, and direct labor will increase by $4. Variable manufacturing overhead costs are going to increase by $2.40, 60% of direct labor. And of course, there's no change to the fixed overhead. So when you look at illustration 7.8, it tells you the manufacturing cost for an unfinished table. Direct materials is 15, direct labor is 10, variable 6, fixed 4, 35. Okay. All this other information would be if we processed it further. So let's find out if we should process it further or not. So in essence, for just to sell it as is, you got a $50 revenue stream, you got $35 in costs. So you're going to make $15 on every table that you sell unfinished. Well, what about if we process it further? Well, we get 60 bucks for that instead of 50, so our revenue is going to increase by 10 bucks. But our direct materials are going to increase by 2 to 17. Our direct labor is going to increase by $4 to $14. Our variable overhead is going to be increased by $2.40, which is $8.40 per table, and $4 in fixed. That doesn't change. So that means we're going to have $43.40 of total costs. And we will make net income of $16.60 per finished table, right? So if we processed it further. So when you do the analysis here, it looks like it's a good idea to process this further and sell it for 60 bucks, because in essence, our net income would increase by $1.60 per table per unit. So should they sell or process further? Definitely process further. Okay. Well, what if you had a company that would have a multiple product line here? Dairy is like that. Okay. So from raw milk here, and actually some people just stop right here and drink it, but I'm not that brave. There is a common process that raw milk goes through that separates the product into cream and into skim milk. Okay, so these are two products from the same process. So we call them joint products. Although today, a joint product could also be something different. So this is where we could stop here, or we could process further. If we process the cream further, we would have cottage cheese. If we process the skim milk further, we would have condensed milk. Okay, so these are the choices. Do we sell as cream or process it further to cottage cheese? Do we sell as skim milk or do we process it further into condensed milk? All right, so that's how we're going to be looking at it. So basically speaking, all of these common processes to process the raw milk into cream and skim milk are simply sunk costs. They're not relevant in our decision to process these products any further. So that's what that's saying here. So let's see what we can do. Well, here is our cost. So our cost and data revenue for cream. Our joint cost is 9,000, and our cost to process the cream into cottage cheese is 10,000. Our revenue to sell the cream is 19,000. These are per day figures. And our revenue from selling the cottage cheese would be 27,000 per day. So should this dairy simply sell the cream or process it further? Let's find out. All right. So if we sell the cream as is, all right, it's 19,000. We may go back and see where we're getting this number here, right? It's 19,000 is right here. If we process it further, that would be cottage cheese, in which we would get 27,000 in sales per day. All right. We already are creating the cream. So there's no additional costs to process cream into cream because it's already cream. However, we would need to spend another $10,000 to process the cream into cottage cheese. And so that really becomes a cost for the cottage cheese product, in which case that would reduce, in essence, right, the profitability of that product from just selling the cream. Okay, so although we would make $8,000 more in profit because the sales would increase, we would incur 10,000 more in costs, which would of course decrease our profit. So if we went ahead and kept processing the cream into cottage cheese, we would lose about $2,000 per day. This is a per day thing. Okay. So should they process or the cream further? The big answer there, no. Stop right there. Or as cows would say, no, no. They would chew stuff while they're saying it, It's a real cow sound. I hope you found that moving. Here is some data for skim milk. So the joint costs to that they allocate the skim milk is 5,000. The cost to process the skim milk into condensed milk is another 8,000. Okay. The revenue from just selling the skim milk is 11,000 per day. However, the revenue if we change it to condensed milk would be 26,000 per day. It's a pretty big difference. So let's decide whether we should sell the skim milk or make it turn into condensed milk. Okay, so if we sell the skim milk, it's already skim milk. We'd make $11,000 per day. There's no additional processing costs since it's already skim milk. So that would be our profit. However, if we were to sell the condensed milk, we would have $26,000 of revenue per day, which is a lot. we would have to incur $8,000 in additional costs per day, which is also a lot. However, it looks like we're going to be adding some more fat back into this process, because that's a pretty fat profit right there. Huh? Get it? Skim milk, fat. Okay. So in essence, we would be increasing our sales by 15,000. We would increase our cost by 8, but the net effect is a $7,000 increase to net income per day. So should they or should they not process? Well, let's just condense the answer here. They should. They absolutely should. Okay. And I think this should be red, and that should not be red. It's a lot of shoulds. Okay. So the big decision rule is any incremental processing costs that the company is going to take on. Okay. So I hope that came across. So here's our do it exercise for this part of the chapter, learning objective 4. We have a manufacturer, easy does it. I have to say that every day as I get older. They manufacture unpainted furniture for the do-it-yourself market. Okay. They sell a child's rocking chair, make them old while they're young, for $25. Production costs are $12 for a variable, $8 for a fixed. Easy Does It is considering processing it further, which means they can paint the chair and sell it for $35. However, if they decide to paint the chair, it's going to be an increase of $9 to variable costs and an increase of $2 to fixed costs. That's unusual, right? Prepare the analysis whether Easy Does It should sell or paint those chairs, unpainted or painted chairs. Okay. So again, what we have here is to sell the unpainted rocking chair is $25. To process it further, they would be able to sell it for $35. So they would have a $10 increase per chair in revenue. However, these variable costs, which are already at $12, would be increased by an additional $9. So they would go up to $21. Okay. Fixed costs are also affected here. Fixed costs, which are already $8, would increase another $2 to 10. So that looks like to me, Easy Does It should take it easy. I gotta love it, right? So anyway, they should take it easy on this, because if they went ahead and painted those chairs, they'd be losing $1. So they should just sell them as is. Let the kids get splinters. All right. So we're going to take a quick break on that and come back and see if there's any questions. Okay, on to objective 5, which uses incremental analysis to help them decide whether they should be repairing or replacing equipment. Okay. So it just simply is an illustration on a company called Jeffco. They are considering placing a machine with a new machine. Okay. The factory machine originally costs $110,000. It has a accumulated depreciation of $70,000. So they have a book value of 40 grand on this machine. They can use it for 4 more years because it has a 4-year useful life remaining. However, the company is considering buying a new machine. Okay. The new machine that's available is going to cost them $120,000. It's going to have a 0 salvage value, so they're going to run this thing into the ground at the end of its 4-year useful life. Yeah, they really are going to run into the ground. Okay. If they buy this new machine, their variable costs are expected to decrease from 160,000 to 125,000. So it's a big decrease in their variable manufacturing costs with the new machine. And they can actually ditch the old machine for $5 grand. So how an incremental analysis would work is as follows. So certainly if they retained the equipment they have now, they would still need to, absorb quite a lot of manufacturing costs, specifically 160,000 per year for 4 years. So retaining the equipment they already know is going to cost them $640,000 if they keep it for the next 4 years. Okay. But what if they replace it? Well, those manufacturing costs are going to go down. Those variable manufacturing costs are going to go down. 125,000 per year for 4 years with the replaced equipment, with the new one, will lower their costs and save them some money. However, they're going to have to pay for the new machine, right? So they're going to fork out 120,000 for the new machine, and they can sell the old machine, which is going to save them $5 grand. So overall, if they were to replace their current machine with the new machine, it would actually cost them $615,000 over the 4-year period of time versus the $640,000 their current machine would cost them over the same 4 years. So in this case, they would end up saving, they would end up adding $25,000 to net income because their net income would increase, in essence, over that 4-year period of time by replacing it. So should they repair or replace? If you're looking at the numbers, replacing it speaks pretty loud and clear. Okay. So there are some considerations to understand. Remember, the fact that they already have the machine, and that's a sunk cost. So the fact that they already own this machine isn't going to play a factor in deciding whether they buy the new machine or not. It's just, it doesn't even come in. You notice we didn't even put in the book value of the old machine. It just doesn't matter in this decision. Okay. So those costs cannot change, any future decisions. And so, however, when they trade it in and they get some cash back for it, well, that's relevant. That's relevant. And so that part of it is going to matter. But the fact that they've already paid for it and it's got a book value doesn't matter. Okay. So learning objective 5 is short and sweet. And again, it's about repairing or replacing. So let's find out about Rochester Roofing. They rely very heavily on a 60-foot extension lift to work on large homes and commercial properties. Okay. Last year, should be a hint, the company spent $60,000 to refurbish the lift. It has just determined, so this is current, this is last year, right? Anytime you see this last year stuff, it's a sunk cost. It already happened. Nothing to do with today. But it was just determined that they would need another $40,000 of repairs. Alternatively, they found a newer lift, it's used, but in good shape, that's for sale for 170 grand. The company estimates that both their current lift and the new lift would last 6 years. So either way, this piece of equipment is going to last them 6 years, whether they keep the one they've got or buy the new one. However, the lift is more efficient. So the new lift is more efficient and thus would reduce operating costs by about $20,000 per year. So the new lift is less costly on the expense side. That's per year, and they're going to have it for 6 years. The company can also rent out the new lift for about $2,000 a year. The old lift is not suitable for rental. The old lift could be sold for $25,000 if they bought the new lift. Okay. So prepare the incremental analysis to show which lift the company should lift. Sorry. So if they retain the current lift, they would have, again, this costs them money, right? So they would have to spend $120,000 on operating expenses, and they would have to repair it. Okay. So it would cost them $160,000 over the next 6 years to keep the lift that they already got. However, if they were to replace the equipment and buy the new lift, they would be able to rent it out for $2,000 a year for 6 years, which lowers the cost. That's why it's in parentheses here. Of course, they would have to fork out $170 to buy it. So that would certainly take away from their profits. But they can sell the old machine for $25 and save some of that. So in essence, if they bought the new lift over that 6-year period of time, it would only cost them $135,000 versus $160,000. They'd be able to save $27,000 in costs, which simply would be added to the net income. And so in this case, they should replace. Did that lift your spirits? Okay. So we're going to wrap up chapter 7 with this learning objective, which is, using incremental analysis to help management decide whether they should keep or eliminate an unprofitable product or an unprofitable part of their business. Okay. Again, the key here to the decision making are what the relevant costs are. Okay. And so that's important. Understand too that fixed costs usually do not go away if you're going, or most of them don't go away if you are going to eliminate a product line or a part of your business. You're still going to have certain fixed costs that stick around regardless. Right? So you might also see that net income may be affected if you eliminate an unprofitable segment, which sounds weird because it's already unprofitable. I mean, but it would actually decrease more. So that's a very interesting type of thing to look out for here. And in general, how we make decisions is, look, unless you can eliminate those fixed costs over and above the contribution margin, keep it, try to improve it. Otherwise, it's not worth it. So let's take a look here at Venus Company. They make tennis rackets, okay? They have 3 lines of tennis rackets. They have the Pro, they have the Master, and they have the Champ, okay? The Pro and the Master are profitable. As you see here, the Pro had $800,000 in sales and has a $200,000 net income, okay? So it's very profitable for the company. The next line here, the Master line, is also profitable. They have $300,000 in sales and a net income of $40,000. Yay. Champ, I don't know, wasn't a champ for first place, so they were a champ for something else. They had $100,000 in sales and they ended up losing $20,000. Okay. So clearly, not the best. However, when you look at Venus Company in total, this is Venus in total, they're still a profitable company. 1.2 million in sales, 220,000 in net income. So it's very, very good. Even with Champ, they're profitable. So should you eliminate Champ or not? Well, let's find out. If you were to eliminate the Champ product line, okay, your fixed costs are going to be reallocated. 2/3 of them are going to be allocated to the Pro line. 1/3 is going to be allocated to the Master line. So let's go back here and understand these fixed costs for Champ do not go away. That's what they're talking about. So you're going to add the fixed costs. So now your Pro costs are increasing to 100,000. They were 80,000 before, they're 100,000 now. Your Master is increasing to 60,000. They were 50,000 before, they're 60,000 now. Okay. So overall, you have you still have a pretty good amount of fixed costs. Thankfully, Pro and Master are both profitable, but you're not as profitable as you were before. You're not as profitable as you were before. So your net income actually dropped $10,000. It was 220,000 in total. Now it's only 210,000 in total. So that's tough. So don't eliminate Champ for now. Try to do your very, very best, to make Champ a champ. Turn it from a chump to a champ. That's what you want to do. That's the whole idea. So continuing the business means Champ loses 20 grand, but if you eliminate Champ, you lose 30 grand. So you'd be 10,000 more in the hole overall on your profitability. And I don't think you want to do that. So again, this might be an old Champ, but it's still a Champ. Woo-hoo. Now, there's another assumption here. Let's assume that $22,000 of those fixed costs that Champ had can be eliminated. So they actually totally go away. They totally go away. So the fixed costs go from $30,000 to $8,000. So instead of them all being the same, it's actually reduced. Well, if we continue the line, we'd still lose the 20 grand, as you know. However, with this new assumption that a lot of the fixed costs could be eliminated and only 8,000 of fixed costs would be remaining, well, eliminating the business means we're only losing 8,000 versus losing 20,000. That's the same as adding another 12 grand to your profit at the end, because you're reducing your loss for this company, for this product. And so in this case, eliminate. It's time to eliminate. Okay. This is a very interesting story about buck knives. I found it very cutting edge. It's a sharp story for sure. Time to move to a new neighborhood. Maybe, maybe not. Let's see. This was back in 2006. I think they need to update some of their stories in the book, eh? So here they have this manufacturing company, Buck Knives, with 260 employees, and it's a big facility, 170,000 square foot facility. They wanted to move it from California to Idaho. That's, I guess, apparently where the buck stopped. Okay, in Idaho. They wanted to do this because they saw some significant savings. Electricity rates were half that, the cost that in California. Workers' compensation costs were 1/3 the cost they were in California. Wages were 20% lower for factory workers in Idaho than they were in California. And then in addition, so that totaled of $600,000 per year in lowered manufacturing costs if they went ahead and moved to Ohio. I'm sorry, Idaho. Sorry, Idaho. Again, it would cost about $8.5 million to move the factory, plus another $4 million to move all those key employees. That's a nice little way of saying management. Offsetting these costs were an estimated $11 million selling price of the California property. So overall, it wasn't really going to cost them much to do it. So based on all of this, the move should pay for itself within a few years. Well, that was the estimate, and that's what they did. What was the reality? Well, the reality was they only received $7.5 million for the property, not the $11 million they were hoping for. Only 58 of 57 key employees were willing to go to Spud Country in Idaho. Okay. Construction on the new plant was delayed for a year, so that cut into profits and sales, and also increased the cost of the plant, the new plant, 1.5 million more than they thought it was going to cost them. And Idaho at this time had very low unemployment, and they couldn't get the workers. So wages actually were very, very high in Idaho. Okay. They were paying top potatoes for their employees. So a very interesting story. Again, these are all our best estimates as always. Sometimes that matches up with the reality. Sometimes it didn't. Certainly that didn't happen to Buck. Okay. So let's look at our do it exercise here. Lambert, they sell several types of accessories. They have knit hafts and scarves. Isn't that nice? Sales of 400,000, variable expenses of 310, fixed expenses of 120. Therefore, the knit hafts and scarves were losing money. If you only have 400,000 in sales and you have 430,000 in expenses, you are losing money on scarves. Okay, it's not keeping anything warm. Let's put it that way. Lambert is thinking of eliminating the knit hats and scarves line. If they did, $20,000 of fixed costs would still remain. So what should they do? Well, if they continue the scarves line, the hat and scarf line, as you know, they would lose 30 grand. However, if they eliminated it, they wouldn't make any money, but they would reduce their fixed costs to 20,000, so they'd only lose 20 grand. And so the bottom line is they would actually be able to increase their net income by 10 grand because they're cutting their loss. And thus, off with the hat, off with the scarves. Any questions?